If you've ever tried to buy your first home in Canada, you already know that it feels like learning a new language. There are rebates, tax credit, more land transfer tax, stress tests, everything that come under the sun. The good news is there are more programs out there than ever before to help you purchase your first home. Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is specifically designed for first-time home buyers. Now, but before I get started, make sure you give us a thumbs up if you like our video or hit the subscribe button below so that you can stay on top of the latest tax tips. Most people don't even know how much money they're leaving on the table because they simply didn't know the type of incentives that are available to them. And with the new federal tax incentives that simply wipes out the 5% of the GST if the first-time home buyer purchases a new home, there are even more complications and even more confusion that comes along the way. And to throw you another curveball, people also don't understand that the definition of first-time home buyers in the eyes of some of these tax incentives simply do not carry this literal translation of first-time home buyers. In other words, you may have owned some homes before, but you could still be eligible under specific criteria to qualify for some of these incentives again. So with that, let's dive deeper into what programs are available specifically for first-time home buyers and who would meet the definition of first-time home buyers for the purpose of some of these incentives. So then you can make sure that you're taking full advantage of all these tax incentives. Buying your first home or any home in any sense would be one of the biggest decisions that you would make financially. A little bit planning and investigation would allow you to make some sound decision, and sometimes it's between scraping enough money to avoid tens of thousands of insurance. Sometimes it means that you will get a much larger tax deduction. These decisions do not just reduce your tax bill. Many of your decisions will lower your cash requirement upfront, reduce your mortgage payment, or boost your ability to qualify for a loan. In other words, these incentives will help you get into the market sooner rather than later. So here are the 7 items that you need to know when you consider buying your next primary residence. Now, first thing first is the new federal GST rebate on new home purchase from the new qualified home buyers. Basically, this is a program that was confirmed and announced in the latest federal budget. This is the most generous incentive for the first-time home buyers. If you buy a new build home and you're the first person occupied it and you use it as your primary residence, you could potentially save up to 5% of the purchase price of the property. Well, who would qualify to save that 5% GST on new home purchase? First of all, you need to be a first-time home buyer, and this carries a special meaning, not the literal meaning of first-time home buyer. It means that you and your spouse or common law partner have not owned or lived in a home that you own anywhere in the world during the current and previous 4 calendar years. Now, let me repeat that. That means you and your spouse or common law partners cannot own or lived in a home that you own in the past 4 calendar years anywhere else in the world. And then you would meet that definition of first-time home buyer. Yes, you do not need to be a first-time home buyer. You just cannot live in a house that you've owned and occupy as your primary residence anywhere, anytime within the last 4 calendar years. And of course, to qualify for the incentive, you must use the newly purchased home as your primary residence. Now, let me give you a rundown of how it works. You will get your full 5% GST rebate if the purchase price of the home is under $1 million. So maximum is $50,000. If the new house purchase price is between $1 million to $1.5 million, the $50,000 maximum GST portion that's available, GST rebate that's available, is going to be reduced between $1 million and $1.5 million. So if the purchase price is $1.25, that $50,000 GST rebate is going to be grind down to $25,000 only. So as the purchase price of the house gets more expensive to closer to 1.5, then the entire $50,000 GST rebate would be completely wiped out. And of course, there is no rebate about $1.5 million purchase price. I think the government just assumed that you would be too rich to care about the $50,000 $4,000 tax rebate. Another additional incentive in Ontario is that the fall economic update provided by the Ontario government also mentioned that they have the same intention to mirror the Ontario portion of the amount Ontario tax rebate available for the first-time home buyer. Now, what I mean is that in Ontario, when you purchase a brand new home, you are not just paying the GST portion on a new home. You're also paying GST and PST, the combined, which is HST in Ontario. So in Ontario, you're paying both. You're paying 13% on the home purchase. So if the house is $1 million, $130,000 is being added to the purchase price and given to the government. There is a smaller rebate available, but the amount is nothing in comparison to the 8% that you would have to pay to the government. When I mention 8%, it means 8% of that HST. Okay, so going back to the Ontario example, in the 2025 economic statement, the Ontario government proposed to mirror the same rebate system for people who are purchasing homes in Ontario. First-time home buyers who are purchasing their first home from a new builder, and they meet all the qualification criteria, so they would get 8% back for houses that are new house purchase price with $1 million, less than $1 million. Now, they are just waiting for the federal government to pass the law, and then this will be kicked in as well. So let's use a simple example to explain. If you buy a brand new condo for $900,000 and the GST on it is about $45,000, under the new rebate rule, the entire $45,000 GST would be rebated back to you, so more money in your pocket. Now, if you were to purchase a home in Ontario under this new proposed rules, once it's been passed, for the same $900,000 home that you purchased from the builder that's new built, you would have to pay $117,000, 13% of the $900,000, to the government as HST. And if you live in Ontario, that's $117,000 out the door that you could only recoup a very small percentage back. Now, with the new incentives, the entire $117,000 could go back to your pocket, either through the form of price reduction or through the form of a tax rebate. Now, that's a lot of money going back to your pocket and really great tax incentives for first-time home buyer who's buying a brand new home. Now, let's move to the second tax incentive program, the land transfer tax rebate, all available across Canada. The land transfer tax system is governed by the individual provincial government and also the municipal government. So every province has a different set of system. They may be similar to each other, but the way and how much they charge really based on the location of the home. Now in Ontario, we charge land transfer tax. The current system also gives you tax rebate, and the maximum you would be able to get in Ontario is about $4,000. And of course, to meet that criteria is the first-time home buyer. For this land transfer tax rebate purpose, the first-time home buyer literally means first-time home buyer. There is nothing related to 4 calendar years living elsewhere. There's nothing like that for this land transfer tax rebate qualification. So you must be a first-time home buyer for the purpose of claiming that $4,000 Ontario land transfer tax rebate, for the purpose of claiming that Ontario land transfer tax rebate. Now, specifically in Ontario, if you live in the area of City of Toronto, in that boundary, you also need to pay another layer of land transfer tax charged by the City of Toronto. And the City of Toronto also offer a rebate up to $4,475. And of course, you would only qualify if you purchase a property within the City of Toronto boundary. And also, you need to meet the criteria of being first-time home buyer. And you also need to occupy the property for the purpose of qualifying for the land transfer tax rebate. And land transfer tax often catch people off the guard. A rebate would definitely help, especially for first-time home buyer who are purchasing their first home in Toronto, City of Toronto, because you have to pay Ontario land transfer tax and also Toronto land transfer tax. Now, for other provinces, make sure you check with your specific local rules. I know in Alberta, there is no land transfer tax at all, and it helps a lot with our tax planning strategy. But in BC, there is some measure of land transfer tax, but there is also a tax rebate system. Make sure you check with your local rules and not to miss any surprise cost and also tax rebate that's available. Okay, the third program that's available to help first-time home buyers to purchase their home is the First Home Saving Account. So what is a First Home Saving Account? First Home Saving Account is a hybrid between TFSA, the tax-free saving account, and RRSP, the Registered Retirement Saving Account. This is how it works. So when you make the contribution to your First Home Saving Account, the amount that you contribute to your First Home Saving Account can be tax deductible. So similar to RRSP, it can be tax deductible to offset against your income, so you can reduce your tax liability. And the amount that's saved within the First Home Saving Account can grow tax-free, just similar to RRSP and TFSA. Now, when you do the withdrawal for the purpose of buying your first home and you are living in the property, the withdrawal that you are allowed to take out would be completely tax-free. You do not need to pay tax on it. So that's the reason why it works as a hybrid between RRSP and TFSA. Works for the best of both worlds. Now, who can open the First Home Saving Account? Well, you need to be at least 18 years old and you cannot be older than 71 years old. And of course, you also need to meet the first-time home buyer test. And what is the first-time home buyer test? Again, it is that you or your spouse cannot occupy a home that you own in the last 4 calendar years anywhere else in the world. So what it means is that you can also own a home and you rented it out and you never occupy it as your primary residence, and under that scenario you would still meet the definition of first-time home buyer. So what are the maximum for contributions every single year for FHSA account? Well, the maximum you can contribute is about $8,000 per year, and then the maximum you can contribute is about $40,000. Let's say you open the account and you only contribute $2,000 and you did not hit that $8,000 annual maximum that you are allowed to contribute to that First Home Saving Account. $6,000 is available to be carried forward to the following year. And the maximum you are allowed to carry forward from year to year contribution is $8,000. So even if you contribute in year 1, 2,000, year 2, 2,000, you did not hit the maximum in both years. For 2 years, technically, you would be eligible to contribute up to $16,000, but you've only made $4,000 contribution. So you have $12,000 room that could potentially be carried forward. But the rule basically said that you are only allowed to carry forward $8,000 maximum to the following year. So in year 3, you would have $8,000 contribution room carry forward from prior year, and then another $8,000 for that particular year. And lifetime contribution limit is $40,000. So in the lifetime, you can only contribute up to $40,000 into your FHSA account. Now, how does withdrawal work? Because withdrawal can be non-taxable as long as you meet the criteria. And the criteria is that you must be a Canadian tax resident. At the time of withdrawal, you still meet the first-time home buyer test that we mentioned earlier, the 4 calendar year test with you and your spouse, and you owning and living in the same house, living in a home that you've owned over the last 4 calendar years. That's not allowed. That's the first time home buyer test. You must have an agreement that you're planning to buy or build a home that you're planning to occupy as your primary residence by October 1st of the year. And you intend to live in the property within the first year of buying it. You could only make the withdrawal within 30 days after closing. Unfortunately, you could only make the withdrawal once. After the withdrawal, you would not be able to take another withdrawal. Once you withdraw the amount, you have to withdraw the entire amount, and then you close the account afterwards. If you don't end up buying a home ever, you could transfer the amount sitting in the FHSA account to your RRSP without triggering any tax implication, assuming you do it right. Now that we cover the First Home Saving Account, it's also important to talk about the next incentive that's available, and it's often being used together with the First Home Saving Account. This is called the Home Buyer's Plan. This has been around forever. It's nothing new. The Home Buyer Plan is definitely one of the most commonly used first-time home buyer incentives available there, because essentially you're borrowing against your RRSP and you take the money out and you can borrow up to about $60,000 per person. If you and your spouse are together and had been financially responsibly contributing to your RRSP for years, you might have saved up some money. And if you have $60,000 on your own and your spouse also has $60,000 contribution, you guys can both combine together, get $120,000 withdrawal and use it toward the down payment of your first home. That is substantial. So who would qualify for the home buyer's plan? The same first-time home buyer definition that we've talked about. You and or your spouse could not purchase a home anywhere else in the world that you've lived in during the last 4 preceding years. And how does that withdrawal work? All you need to do is to fill out a form called T1036. You can reach out to the financial institutions that have your RRSP account that hold that investment for you. You can then contact them and they will direct you to the right withdrawal form. And on that form, you just need to declare that you're using your home for the purpose. You're buying a new home and you meet the definition yourself. Don't ever rely on the financial advisors to tell you whether you meet the criteria or not. It's on you because it's your tax return, your financial responsibility, your tax responsibility. So make sure that you fill out the form, submit it, then you can take the money out tax-free. Now, there is a catch of using the home buyer's plan. The catch is that you're borrowing against your RRSP. What it means is that you can withdraw it tax-free at the time when you use it, but you need to repay it over 15 installments the 5th year after your withdrawal. So what it means is that if you withdraw the full $60,000 as available, the 5th year after your withdrawal, you have to contribute back, repay by contribution. You need to contribute $4,000 back to your RRSP. That's considered repayment of that loan. And that's how you gradually repay that loan, so then your RRSP plan will be built up over time for that $60,000. And if you don't make the repayment, all they would do is to add that $4,000 minimum repayment amount as your income and you pay tax on it accordingly. Now, I mentioned earlier, it is an excellent idea always to combine the use of your FHSA account as well as HBP account. So your first home saving account would allow you to essentially contribute $40,000 and reap the benefit of investing and everything and growing it tax-free. And the home buyer saving account, you would only be eligible to claim to borrow up to $60,000. That amount is fixed between the $60,000 and $40,000 contribution or even more after you invest and grow the FHSA account. The combine of the two, assuming you have the maximum available, is as minimum $100,000. If you are able to grow that $40,000 maximum contribution in your FHSA account substantially over time, then you would be able to get more out of the combination of these two accounts. So the rule of thumb is try to maximize the withdrawal and leverage both at the same time. So the 5th incentive that's available is a small tax credit that's offered on your personal tax return. You just need to tell the return that you just purchased your brand new home as a first-time home buyer, and you would be able to claim up to $1,500, assume that you qualify. And the amount can be split between you and your spouse, but up to $1,500 as a family. Okay, the 6th incentive that's available is not exclusively available for first-time home buyer, but it is widely used among first-time home buyers because this program allows buyers in the market to purchase the home that they occupy with less than 20% down payment. So this program is the mortgage insurance program available for people that are intending to purchase their home with less than 20% down payment. Without this program, traditional banks would not offer high ratio mortgage. High ratio mortgage means that you're borrowing more than 80%. Traditional bank generally would not lend to you if you're borrowing more than 80%. So a lot of the time, our first-time home buyers would be having a hard time pulling in enough funds to purchase their first home. So they may come up with some money, but they may not be eligible or they may not have enough money available even with all the incentives. So this program essentially allows you to buy insurance to make sure that the bank is covered in the case that you would not be able to repay them. So without this insurance, the bank would not approve the high ratio mortgage at all. Now, there are specific down payment requirements. If you're buying a home for less than $500,000, you can pay as little as 5% down payment to purchase the home. So 5% times $500,000. If you are buying a home for $500,000, all you need is $25,000 as your down payment. That's pretty awesome. It is only available if you also purchase the CMHC insurance. Now, if you're buying a home that's more expensive than $500,000, depending on the purchase price of your property, there are specific guidelines in terms of the down payment requirement. So if you buy a home for $100,000, the first $500,000 you can pay 5%. The second $500,000 you need to pay 10%. So the first $500,000 times 5%, and then the second $500,000 you have to pay $50,000. So you still need to combine, pay a total of $75,000 as your down payment if you were to purchase a home up to $1 million. Now, if you are buying a home over $1 million, you need to pay full 20%. And these rules may change from time to time, so make sure you check the CMHC website. Now, when you're buying insurance, we all know that you have to pay the insurance company to insure your creditability. And in this particular case, there is a cost associated with buying that insurance. And these insurance amount, you don't have to come out right out of your pocket right at the moment. It's being added as a part of your mortgage amount. As an example, if your down payment is 5% to 10% of the purchase price, you need to pay 4% of the mortgage amount as your insurance, which is added to the cost of your mortgage. You don't see it as part of your immediate outlay on closing, but it is being added to the mortgage and it's being paid over the amortization period of your mortgage. And if your down payment amount is between 10% to less than 15%, then the mortgage insurance amount would be 3.1%. If your down payment amount is between 15% to just under 20%, the mortgage insurance amount would be 2.8%. So these amounts could be substantial. I mean, if you're buying a house of $1 million, the mortgage insurance could be tens of thousands of dollars. The good news is that you don't have to come out of pocket immediately at closing, but the bad news is that you still have to repay it. It's just repay as part of your mortgage payment. You can always refer back to my blog post, which would be part of the link in the description below, to see an example of how this CMHC insurance is calculated and how it's being added to the cost of your mortgage. Now, finally, back to the seventh point, this is not a tax incentive. This is a reality check that back in the days when I used to work as a real estate agent and I helped first-time home buyer to go through their numbers, mostly with my friends. When I went through that calculation, first-time home buyers are often caught off guard with the amount of closing costs that's required to purchase the home. So I wanted to walk you through some of these expenses so you would not be caught off guard how much you would actually need to come out before you purchase your property. Now, closing costs, typically they said it's between 1.5% to 4% of your purchase price. So on top of the down payment, you still have to come up with this closing cost. So when I talk about closing costs, it's referring to the land transfer tax, referring to the title insurance, it's referring to the legal cost, and also any potential adjustments required when you purchase a property. Let's use an example to illustrate how much closing costs could be. Now, let's say you purchase a home specifically in Toronto for $850,000. First of all, the Ontario land transfer tax would cost you $13,475. And the Toronto land transfer tax would cost you the same amount. So it's the same $13,475. But then because you're a first-time home buyer, so you get the rebate. So you now get to reduce that amount by $8,475. Now, legal fees, depending on the lawyers and depending on who you talk to, is easily between $2,000 to $2,500. And then you also need to purchase something called title insurance. And the title insurance could be $500 to $1,000. And if you're buying a home, you are closing, sometimes the closing date does not end on the same billing cycle. So you might have to pay the seller some utilities that were paid or property tax. Those adjustments depends on the situation. Sometimes it could be a couple $1,000s, a few $1,000s, and sometimes it could be like a few $100s. So in my example, I estimated it between $300 to $800. So then the total cost for closing would be anywhere between $21,000 to $23,000. So that could be quite substantial for someone who's not aware of the closing cost. You may also want to go back to my blog post to look at other examples for homes that are purchased in other provinces. Now, using the same numbers, let's pull all the tax incentives together and see how much you are able to claim or save all together. Now, let's say you purchase the same home, $850,000 in Toronto. You could potentially claim the federal GST tax rebate, and you could also potentially claim the Ontario sales tax rebate. That could be 13% on $850,000. Right now, the legislation hasn't passed, but we are expecting it to pass. And once it's passed, you would be eligible to claim 13%, assuming you meet all these other criteria. So that's number one. And then there's the Toronto land transfer tax rebate for $4,475. You can withdraw from your FHSA account of $40,000 or whatever that amount is from your FHSA account, and then you can borrow from your RRSP for up to $60,000. And at the end of the year, when you file your personal tax return, you would also be able to claim $1,500 tax credit on buying your first home. So not bad, eh? Now that we've covered all the 7 items that you should consider before buying your first home, and we also talk about the definition of what constitutes a first-time home buyer. If you still have questions, make sure you visit my blog post, and we'll put the link below because there are some other examples in my blog post that may be able to help you think a little bit more, plan a little bit better. Make sure you also contribute to your FHSA account, contribute to your RRSP account, take advantage of all the tax incentive available. Until next time.